So I'm going to run through the rest of the pillars. And the next pillar, which is quite interesting, is the pillar on capacity of local investors. And the question is, why is this important for a financial market? We've realized that, as we mentioned, if a financial market is open to foreign investors and it gets to a point where a foreign investor needs to exit the market, it's important to have a backstop, which will normally come through participation from local investors. Then in the context of Africa, we've also realized that increasingly there are policies that try to promote domestic ownership of African investments. So if you go to Namibia or you go to Tanzania, or recently you've seen in Ghana, governments are passing policies that says that if there is any instrument that is issued on the market, whether it's on the stock exchange, whether it's a bond, they want local participation to go up. But what we've actually seen in reality, whether Tanzania or Ghana or Namibia, is that there has been issuances in the market, so securities have been issued on the stock exchanges, equities have been issued through IPOs, and the local take-up has been very weak. And that talks to the amount of capacity or the amount of muscle that local investors have to be able to carry the market, either to implement government policy or to be able to buffer when foreign investors are exiting the market. And one of the things that we discovered in the year of review was the misalignment between what policy makers think they do in the market versus what investors within the market want to be done. So in a lot of the markets, you have investors that are very keen and want to invest in products. And then on the other side, you may have a policymaker who implements a policy that goes against what the investor is trying to do. So we've seen a couple of markets where products have been rolled out, but because of policies, investors are unable to access those products. So that is one side, the policy deficiency. And then the second part has to do with education, which is also discovered in this pillar, where in many instances you also see policies are actually flexible to allow investors to do what they want to do. So you go to places like Kenya, and the policies are quite flexible for investors to be able to invest in different products to diversify their income and to grow returns. But then you see trustees and people who manage risk within the corporate environment are not up to speed in terms of understanding what products to implement and how to manage their risk by accessing financial market products. So in this pillar, there are two things that are a focus. The first thing talks about pension fund holdings of issued investment in the market. And then the second one talks about the pension fund per capita for all the markets. And it's important to also recognize that this pillar was the pillar where most of the countries actually had a very low ranking or low marks. And therefore, it presents a lot of opportunities in terms of what Africa can do to boost local participation in its markets. On the details of this pillar, you will see things that have been done in various markets to really promote local participation in the financial market. So we've already mentioned what South Africa has done, for example, by increasing the foreign ownership of South African fund of the fund management sector within South Africa, increasing foreign ownership outside Africa from 25% to 30%, and then the foreign ownership in the rest of Africa from 5% to 10%. And we think things like that are very important because it enables fund managers to diversify their risk, and in times of turbulence in local markets, they are able to still achieve better returns for the funds that they control within the market. We've also seen things being done in markets like Uganda, where they've passed an integrated financial market strategy that pulls all the sectors together and importantly focuses on financial inclusion. So those are really good policies that have been introduced in some markets, which we believe other markets can adopt as well. Then we've seen policies in Nigeria, for example, which have also promoted a diversification strategy within the Nigerian system. So previously, pension funds couldn't access derivative market to be able to hedge their risk, but now they can. But then on the other side, there is a cap on how much you can access in the domestic market if you are a pension fund in Nigeria, which then works against the pension fund sector, and it's also something that Nigeria probably need to focus on. Then you go to Kenya, there are some investment vehicles available, but then you look at the range of investment vehicles available in Kenya, and you compare to South Africa, and it's basically dwarfed in that respect. So there is a need for Kenya and Kenyan market players to really invest in the range of products that investment managers can invest in. If you look at the top risers, I've already mentioned Nigeria, big policy changes that have happened there, and you can see what that has caused in terms of moving Nigeria 6 points on this pillar. Morocco has done a similar thing to Nigeria. Then you come to places like Mauritius, where there is limited product for pension funds to actually invest in, and that impacts Mauritius almost instantaneously. Tanzania is a space to watch. There's been some policies that have been implemented in the pension fund sector. We are not sure how that is going to pan out. I think it's something to watch for the future. But for now, it doesn't look like actually promoting local investments. Then there is the pillar on macroeconomic opportunity that talks about not just the growth of individual markets to an investor, but also talks about the quality of growth that different markets go through, as well as the transparency around the growth. So what investors have increasingly said is that, yes, Africa is growing very fast, but we understand the growth. And this is exactly what this pillar tries to measure. And the key things here is that, yes, Africa is a growth play, but it is important that for this growth to be sustained over the medium term, Africa must diversify, right? And then there also need to be a lot of investment in infrastructure as well. And the critical point is about transparency around the growth numbers. So we measure things like growth itself, measure things like debt profile, measure things like macroeconomic data publication, and then there is also data release and MPC outcome transparency. So here again, you can see South Africa offers a best practice, but an interesting thing that is developed here over the past 1 year has been Egypt. So Egypt has basically crawled out of a massive kind of slowdown in the economy into a moderate realm, and as they were migrating from the depression in the market into a growth phase, what they've done is actually transform the whole data supply to the macroeconomic system. So to investors have much more transparency, whether it's around MPC results, whether it's around budget numbers, etc. Egypt has done a lot of work, and we've seen, as you see here, Egypt has actually moved by 10 points. And I think this offers another opportunity for other countries to follow what Egypt has done. We've seen a similar trend in Morocco, which is also building up quite fast. We've seen South Africa slip slightly, and it's mainly driven by the fact that South Africa went into a bit of a recession. And then countries like Mozambique also suffered a bit because, as you all know, they went through a debt crisis, and that really impacts the investment case for a country like Mozambique. Then the last pillar is one that is really critical, and it talks really about property rights across the continent. And I think, as you can see, the shape is not looking as great as you saw in, let's say, a pillar 3 or maybe a pillar 1. I mean, what this pillar actually tells us is that in a lot of instances within the continent, when you execute transactions, the certainty about your right to the transaction is actually not guaranteed, which impacts on your ability to execute a transaction in a market or not. If you want to put it another way, it tells you that the risk of executing transactions across the continent is basically exaggerated, right? So to give you an instance, if you execute a spot transaction, your normal risk should be like 5%. But in the case of Africa, for countries that haven't sorted out their legal regime to ensure enforcement and respect for property rights, that risk moved from 5% to 95%, right? And these are opportunities for African economies to really solve some of these issues. And once you solve it, your risk profile actually comes down significantly.